Hello everyone and welcome once again to the OANDA Market Pulse Charting Analysis Update. My name's Craig Erlam, Senior Market Analyst at OANDA. As always, we're going to take a look at some of the charts which I've picked up today, which I've believe has seen some interesting developments. Now, I think you may have seen this morning we had those UK CPI numbers out, which has led to some interesting moves in the pound. Now, you may remember from yesterday's TA video, the FX TA video, that we were talking about cable, how we had this recovery, we had a move back towards the 50 fib level around these 166.65 levels, and then we had the formation of this triangle, and the triangle really in these situations is neither typically bearish or bullish. It just represents some form of indecision, and you wait for the breakout to determine which direction that's in, and I think given the rebound off that 50 fib, I think I was leaning, if I remember correctly, towards the bearish side of things, and we have actually seen a breakout below here today. Now, I'm not going to claim any credit whatsoever for predicting that, assuming I did actually correctly predict that yesterday. This was driven by that CPI reading that we had out this morning. We had the release around 9:30 this morning, and the overall CPI reading was in line with expectations, with a slight increase at 0.3%, but the core reading was actually a little bit weaker than expected. Now, I think we've got to remember a couple of things here. The overall CPI reading is being driven still by these movements in the oil prices. Last year it was almost artificially low, I guess, due to the fact that we had these massive declines in oil prices, which really exaggerated the level of deflation that we were actually seeing. But what we're actually seeing now is the fact that we're just over a year on now. The initial declines in the oil prices are actually starting to fall out the year-on-year comparison, which is why we are seeing the CPI start to gradually rise. So in the same way that we were focusing on the core CPI for the last 12 months, I think the markets are continuing to do that again, because that strips out the bulk of the effects from the movements in the price of oil. So the fact that we actually saw a weaker CPI reading, or core CPI reading today, was bearish for the pound, because it shows that inflation isn't picking up, which could delay the rate hike from the Bank of England, as and when that may come. Now, people aren't anticipating a rate hike, or a lot of people aren't anticipating a rate hike until the end of this year at the earliest, and maybe today's CPI reading did just push out those expectations a little bit, which has led to some weakness in the pound. So we've seen a break through the bottom of this triangle off the back of that, and we've seen it break straight away through this next support region. We're looking at around 143.25 to 143.50. You can see that on a number of occasions previously this was a notable level of resistance, and then turned support here once we got the break above that region, and we saw this region provide support again back on February 8th. So we did find support initially here, but following a little bit of consolidation, we have broken through this level, which brings this region into view for me around these 142.20s to 142.50s. Now, you can see again on a number of occasions recently this has been a key region of support and resistance. So having broken through this previous 143.25 level, this is the region I'm now eyeing, 142.20 to 142.50 as the next possible region of support. If we see a break below here, then I'm looking back at these 141.70s to 141.50s. Once again, you can see more recently on January 26th and January 29th that this was important region of support, but even at times back earlier on in January as well, you could see that this was a notable support as well. So I think things are looking much more bearish once again for cable following that break, and really I think it wouldn't surprise me if we're looking back at these low 140s once again in the coming weeks. Next is sterling yen, and again we've had a similar impact in sterling yen that we had in the pound against the dollar, of course, because weakness in the pound has driven this pair lower. Now, you can see that we had this volatility around the actual event itself, so we did have a little bit of a nip higher, and to be honest, in the lead up to the actual release itself, this was potentially looking a bit bullish, because we had the consolidation and it was around that 38.2% Fibonacci retracement level. That's looking from the highs on February 1st to the lows on February 11th. Potentially looking a little bit bearish just because we were having these higher lows being made, but the resistance was always the same. So this is a rising triangle potentially that was forming in the lead up to this release, which is typically bullish. And given that we've got this 50 fib level here coming in around the previous highs and a previous support, I think this could have been a potentially, without the release itself, could have potentially been a logical resistance level for the pair to find around these 167.50s. But instead, following the release around the 166s, we did see some volatility and a move up to 166, but this was then heavily sold into, and since then we've the selling just has continued. So the fact that we've now seen this drive lower off the 38.2 fib would suggest that we're going to see another assault on this prior support, and this is where of course, the February 11th lows, but also when we're looking further back at what we've got, which is this longer term head and shoulders on the chart here. We've mentioned on Monday's video that the conservative possible price projection was already hit last week. And now it looks like we're going to see that level tested again, and a break of that could see us moving back towards these 153 levels, which is the more aggressive price projection, possible price projection level, which is based on the move from the head to the neckline, projected lower from the break again. So like I say, the 153. So if we can see this level broken, then we could see these 153s come into play. But I would highlight as well around these 156s is the I think it's the 50% Fibonacci retracement. Is the 50% retracement of the move from probably best bring this up on the weekly chart actually. So that's the 50% retracement of the much longer term move from these lows back in September 2011 to the highs in July. So I think this could be a very notable level as well. A little bit short of this more aggressive price projection target, but the fact that it coincides with this previous support and previous resistance and is the 50% retracement of a much broader term trend, I think we could see a lot of support being found around these levels. Next up is Euro Sterling. Same story here. Sterling weakness is bullish for the Euro Sterling pair. Now I did mention previously the fact that we had this slowing rise in Euro Sterling when it was coming off the back of this bearish divergence on the stochastic, the MACD histogram and the MACD moving averages, and then we had the break below here which was bearish. We did hang up around these 77s for a while, which is previous resistance and more recently support, and we've also got the 55 period simple moving average here as well. But this was still looking bearish prior to this release in my view. This looked like a bearish a continuation pattern, but the release of course meant weakness in the pound, which has driven this pair higher. But what I find quite interesting at this stage is while we have seen a move higher, you can see the slope of that previous trendline support is still currently providing resistance for the pair around those 78s. So while I'm not necessarily saying I'm bearish at this stage, I'm going to wait and see how this next candle also plays out. There is clearly resistance being found at these 78s at this prior trendline support and resistance. If we can see a close above that trendline resistance, then I'd be looking potentially, well, initially back at this 78.50s, which was previous resistance back in February, and above here this really important zone for me, 78.75 to 79 being those previous highs. That I think that's going to be a big key test. But like I say, assuming that we don't see a break above there, say we get a close below the open on this 4-hour chart, but then we could be left with a nice shooting star candle, potentially an indication of a continuation of the move to the downside. It'll actually be interesting to see whether that marks a key fib level. See, that's falling just short, literally talking a few pips there, of the 61.8% retracement of the move from those February 11th highs to those most recent lows. So if we can get a nice reversal set up, oh god, if we can get a nice reversal set up on that level, then that could be a nice bearish indicator for us right there. Let me just configure this so we get rid of some of that noise on the chart. Personally not as interested in the 23.6 fib retracement level or these broader expansion levels. There you go, much nicer. So I'm looking for potentially a nice reversal on that 61.8 fib, given that it's coming on trendline resistance. Not really seeing it on the 1 hour chart at this stage. Let's take another look deeper at this on the 30-minute chart. Potentially seeing some, I think this could potentially give us some form of indication here, because we've seen a little bit of a correction. This could even be like a flag formation or something, which is typically quite bullish. So the next test is going to be those 78.12 highs. If we see those 78.12 highs broken, then I think I'd be inclined to be relatively bullish at this stage, given the fact that we have seen this little bit of consolidation now being bought into. So we get a little bit more information there from the 30-minute chart than we've currently got from that incomplete 4-hour chart. Let's move on to some commodities next, and I'm sure many of you are aware we have seen some selling in Brent crude and WTI today. I'm sure many of you will also be aware of the reason for this. We had a report earlier. We had reports late last week that from the UAE energy minister, who suggested that OPEC were open to discussions with other oil producers regarding a possible cut to production. We saw the markets rally off the back of that, and they've been rallied on the back of that into today. Reports yesterday suggested that the Saudis and Venezuela and Qatar were going to meet in Doha with Russia to discuss possible production cuts. So again, that led to some more strength in oil. And what they actually agreed on, which I guess is progress, but not the kind of progress maybe that the markets were anticipating, was a production freeze rather than a production cut. Now that's only an agreement between those 4 oil producing countries. That doesn't include other countries. It certainly doesn't include the US. So I think the markets, what we're seeing in this selling today, is disappointment at the outcome of a meeting which had built up to be possibly the start of production cuts, and supply falling closer in line with demand, and maybe a decline in these inventories, which would have lifted oil significantly further than that. But what's interesting is we've run into this 55-day simple moving average and found nice resistance. We haven't made a new higher high, and we are now trading below yesterday's opening levels. So for me, this is looking relatively bearish. Once again, I'm looking at these $29.50 to $30 level as the next key support for me, given that it's most recent support, and a break below here would make a new lower low and would possibly suggest we're looking back towards these 27s in the coming days and weeks. WTI pretty much tells the same story here. In fact, we actually saw a rebound off those previous support and resistance level around the 31.50s, just above the 61.8 fib. But more importantly, right now, if this daily candle closes as it is, that is a very nice shooting star candle with a nice red body on top of that. For me, that's looking quite bearish, and once again, I think we'd be looking back to this very key support zone around 26.50 back to 25.50. You can see this was key support back in January 20th and also again on February 11th. So for me, following today's announcement, I think things are looking quite bearish once again. Finally, gold. Now, this is possibly not quite what people are expecting when we say that we're kind of not entering, I guess, but the risk-off environment does appear to be easing somewhat, which would typically be bearish for gold, because you can see gold has benefited greatly this year from this risk-off environment. The panic in the market, the fear in the market really has driven gold through those 1200 levels as high as 1264. It's driven gold as well through that long-term descending trend line, through that key at one stage, that key region of support of resistance, which has been massive for some time on a number of occasions. You can see here support, resistance, and it's that risk aversion in the markets drove it through there briefly before being driven back below. But what I find quite interesting now is that even though we're seeing a bit more risk on markets, or less risk aversion I should say, we've pulled back towards these 1200 levels, and these have actually been bought into. So this is where we've got previous resistance turn support, we've got previous trend line resistance also appearing to turn support, and look how strongly this has been bought into today. So we had the sell-off earlier in the session back towards these 1190s. That's just been driven higher, and now we're actually trading higher on the day. If we can get a close like this, that would start to look quite bullish for me. I think the bears may be a little bit worried if we do see a higher close here, given that how the number of resistance levels turn support, and the fact that we've actually finished higher in the day. So despite the fact that we appear to be moving away from such a risk-off environment, gold seems to potentially have some upside left, at least possibly back towards these 1260s, and see if that 1264 can be tested once again. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.